COVID-19 pandemic hit, investors limited their portfolios to well-established companies and stock corporations. The pandemic, with its uncertainty, layoffs, and multiple closures, exacerbated the tendency to patronize known brands. Hello, everyone. Welcome to the Analytics Insight podcast, where we talk about the ever evolving tech space. And I'm your host, Priya Dialani. Manual legacy systems in the capital market lack transparency and efficiency. But on the other hand, they deny investors the required visibility of underrepresented businesses, and on the other, restrict growth opportunities for smaller but promising entrepreneurs. Using AI in capital markets can catalyze inclusion, diversity, and equitable opportunities for investors and corporations. So, how can AI augment the capital market and financial services? Let's welcome Nathan Powell, founder at Deep Market Making. Hi, Nathan. How are you doing?
Great. Thank you so much for having me.
Great. It's a pleasure to have you with us on a podcast. And I think we are going to explore and have a very insightful conversations around capital markets, the use of AI and other technologies, and understanding its overall impact. But before that, we would like to understand and, get kickstarted with understanding what exactly is deep market making. If you can help us understand more about it, its specialization in services.
Right. So right now we're focused on the U.S. corporate bond market, and we have the most accurate AI for predicting corporate bond prices in the U.S., and that's using deep learning. So the focus overall, just taking a step back from corporate bonds, is to apply AI to the capital markets, starting with fixed income, which is an overall larger umbrella than just corporate bonds. And we feel that we've made quite a bit of progress with that so far, and we're getting some traction with the market in corporate bonds, specifically with the traders. And then we're adding to that mix the researchers and analysts and salespeople. And really, it's about both improving the revenue of the traders as well as their efficiency. And we're getting good feedback that we're starting to really accomplish that mission.
Great, yeah, we hope so too, and our best wishes are with you. And when we're talking about corporate bonds, and how these technologies can help traders improve their revenue as well as efficiency, we would also like to know more about yourself. So I think you have an exceptional track record of collaboration with household corporations like Microsoft and JP Morgan and Chase. So if you could tell us more about yourself, your journey till date, and what exactly triggered the birth of the company.
Sure. Yeah. I mean, I spent most of my career in technology, actually. I got a computer science degree and then worked at places like Amazon and then Microsoft. At Microsoft, I was helping them using machine learning and data science to optimize things like how do we display ads on the search engine result page, on Bing. And I was able to help them earn a lot more money, over $100 million in A/B tested additional revenue that were from projects where I led or was the primary person involved. And but I was part of a larger team that did something like 2 billion while I was there. But it had a large effect to actually really get very good at doing A/B testing and using machine learning and data science with that. And then I got also an opportunity to work with Susan Athey, who is a chief consulting economist at Microsoft. And she really helped opened my eyes to all the possibilities in terms of applying economics to problems like optimizing ads. And then I also got involved with question answering with the search engine. So this is like a precursor technology to what we have on Bing now with the OpenAI collaboration. So back then we were applying language models in deep learning. So they wouldn't be classified as large language models, but they were language models using LSTMs and other techniques. Certainly we had attention layers involved. And it was impressing everybody that, a model itself could actually summarize quite a bit of information inside of itself without making a query out to the internet. So that was a new thing. Now that's common knowledge with ChatGPT and other tools. But anyway, then, I had success at Microsoft. I wanted to see if I could have success in a completely different area. And I was interested in the financial aspect, having worked with Susan Athey and everything. So I went ahead and went to JP Morgan. I ended up at the Center of Excellence for Machine Learning. That's like an applied research group for taking deep learning and applying it to the rest of the area, to various areas in the bank. And so the biggest project in terms of success that I got involved with had to do with corporate bond pricing. So I was able to help them come up with a model that way outperformed the existing model that the quantitative researchers had come up with. And also they measured it against Bloomberg's B-Val, and it was better than that. And so that eventually led to me starting this company, Deep Market Making, where we have a completely new model that is quite a bit better than the one I was involved with at JP Morgan. And now we're going out there to sell it to the broader market. And so that everybody can share, all the traders in Wall Street can share in this technology instead of having it just in one large bank.
Great, quite fascinating, Nathan, and thank you for sharing us your journey and the idea behind Deep MM. In the info I mentioned about artificial intelligence, and so the integration of AI or machine learning in credit trading has been ongoing, but the process of aligning these advancements with the nation's development goals is just beginning. So across the board, I think banks and startups are also diving deep into these technologies, and they're intuitively grasping the capacity to amplify financial inclusion and propel economic expansion. So we wanted to understand from you, what are your views on the use of AI in the overall financial and trading sector?
Yeah, I mean, for one thing, I think part of our mission is to improve access to the corporate bond market and to fixed income in general for the average investor, including retail investors worldwide. So one thing that we're going to do is eventually publish a subset of our data to the wider world via widgets, where you can embed, let's say, a graph about a particular corporate bond's pricing on a website, any website around the world, and it just works. I think it'd be great to integrate with existing brokers like Fidelity and Schwab, et cetera, and have that data available. Because right now, if you're a retail investor and you go on Fidelity and you look up a particular corporate bond, you maybe get an end-of-day price from yesterday, from the last trading day, but you don't really get an up-to-date price. And the brokers really do take advantage of retail investors because of their lack of information, and they charge enormous fees. The other thing that I'm also looking into is I recently attended a conference, Blockstart Scotland, and there I spoke on the need for AI to tokenize real-world assets that are less liquid, such as corporate bonds, because you need an AI to fill in the gaps between trades, because often there's a big gap between trades for a corporate bond. And so I think tokenizing corporate bonds would enable access to at least the risk profile of a corporate bond, and also the benefits of getting the coupon payments to anybody around the world who wants to buy the token. You don't have to be, in a regulated broker in a certain country in order to access it. So I'm looking forward to implementing some of those initiatives.
Yeah, I think that pretty much makes sense. In your mission and vision to improve access to corporate bond market is something that like the entire or the overall industry is lacking in the current time. And I think the overall finance sector has always been about analyzing data to predict risks and also the returns. Yet, with the vast amounts of data in today's digital world, there are very limits to the human analysis, and that's when we on board with AI, because they kind of help to find the needles in the haystacks of the data. So while we spoke about the use of AI and other technologies, probably in increasing inclusion with the corporate bond market, why has it taken so long for AI to make headway in finance in general, and is it actually now ready to transform the corporate credit bond and financial market?
That's a great question, and it's something I think about a lot, actually. My theory as to why the financial markets have not incorporated deep learning is because of a difference in philosophy between the technology industry and the financial industry. So in the technology industry, it's all about empiricism. It's all about you run an experiment. Is your model more accurate than whatever was used previously? And if deep learning is more accurate than like linear model or a boosted decision tree, which is what we used to use at Microsoft before we had deep learning, then you go ahead and implement it, and it's great, and it improves the user experience, it improves revenues, and everybody's happy. In finance, it's a little bit different philosophy. I mean, if you go and get a financial engineering degree at a place like Columbia, you are taught that a good financial model is a formula that makes very simplifying assumptions about the financial system. And then you prove that your model is a good model for that financial system. And so when those people that are educated in that way look at something like machine learning, they're like, well, I don't know if it works. I had a boss at JP Morgan, for example, I would tell him, okay, what if one model has better metrics, better accuracy metrics than another one? And he would just kind of shrug his shoulders and say, I don't know if it's good, because in his mind, the only way to know whether a model was good was whether you could prove mathematically that it was good. But the big problem with that is that you're using very simplified assumptions when you prove those formulas. And in the real world, they typically fail to be very accurate. And so the ironic thing is that the people who are entrusted for pricing decisions at a big bank like JP Morgan are actually the human traders. And those human traders have giant neural networks called human brains that have, 10 to 100 trillion synapses. And these are the people that have tons of experience looking at lots of data coming in from the market, and they gain an intuitive sense of where things are going for a particular bond as they look at enough data. And so what we're doing with deep learning is we're emulating and learning from the way that the traders think rather than the way the quants think. So it's just a different paradigm, and that's part of why we're selling directly to the traders and instead of trying to primarily sell to the quants. We will sell some of our product to the quants because it's a useful data feed, and hopefully there will be an innovative subset of the quants who like machine learning, who have taken machine learning courses in addition to the traditional financial engineering courses. But I think that's a primary thing, and it really bears out in the numbers. I mean, you're totally right that the financial industry has been slow. For example, if you look at JP Morgan, which has 57,000 technology people, and then Netflix, which I estimate has about 6,000. Because they have about 13,000 in total employees. So they're a technology firm. So at most, I think they have 6,000. Well, it turns out that Netflix has over 200 job requisitions that mention deep learning. And JP Morgan has 283 last time I checked. And so they have about the same order of magnitude of jobs mentioning deep learning, even though JP Morgan is almost 10 times larger in terms of technology people. And JP Morgan has been one of the more avant-garde companies in terms of incorporating deep learning. I was on one of the teams, but it's still a very, very tiny investment to, compared to what I'm used to in the technology firm. So I think in terms of will that change now, I think what we're going to do our best to lead and show that, it's important to look at the empirical results on something like deep learning. And even we'll argue that it begins to be part of your fiduciary responsibility to incorporate the best technology when making, algorithmic trading decisions or other decisions that require this data. So, and the other aspect to that is explainability. There's a regulatory aspect where when something goes wrong, you want to be able to explain why a model had some sort of output. And so adding explainability tools is important, and it's something that's very important on our roadmap that we're working on.
Right. I think the difference of the job numbers that you shared between Netflix and JP Morgan is it practically highlights the difference of philosophy of the tech and the finance industry, and that you mentioned about it. And yes, there's no doubt that the finance industry is slow in integrating these technologies. So in your earlier responses, you mentioned about using language models earlier back then. I think in recent years, I think most of the listeners, of course, know about large language models like ChatGPT, and they have seen considerable advancements and have been applied in diverse fields. Now, built on the transformer architecture, these models are trained on extensive data sets, enabling them to understand and generate human language effectively. Now, if we talk about its application in the financial domain, I think the deployment of these models, large language models, are gaining momentum slowly. So they can be used for automating a financial report generation, forecasting market trends, or analyzing even investor sentiments and offering more personalized financial advice. So we want to understand from you, how do you think that these models, like the large event models, will transform the credit trading and portfolio management?
Yeah, that's a great question. And I totally agree with you that language models are gaining a lot of traction in the financial markets versus other types of models like the one, our primary model, which is a regression model, quantitative model. So, for example, Bloomberg has their large language model that, has been trained on more financial data like from the Bloomberg chat. And also JP Morgan, just announced that they have a large language model for internal use by various teams. And I also saw that at the Center of Excellence that I was on, is that more of the team was allocated towards the language model work than other initiatives like what I was working on with regressing on corporate bonds. And yeah, I think there's a lot of potential for that. And I think there's so many use cases for language models in finance, that finance is very document driven. And when it comes to corporate bonds specifically, we have all of the documents that are associated with each corporate bond that make them unique. The offering documents, and then you also have all the like EDGAR related documents related to the corporation as a whole to understand what the state of the corporation that is backing a particular bond is. And then you have corporate loans, which are related asset that are not normally traded on the secondary market the same way that corporate bonds are, but are still actually traded. And there's just a lot less data available. But if you can have a large language model help you in a more automated way understand the loan so that you can understand what the appropriate price should be, that would obviously be very helpful. And then there's news, like understanding what is going on with the news for that particular company. And we haven't yet incorporated news into our model, but it's definitely on the roadmap.
Right. Yes, I think that definitely makes sense. And the large event models and overall the LLMs are basically gaining more traction. And I think in the future we'll see more expansion of the capabilities in the financial sector. But I think AI and these emerging technologies or deep learning for that matter, they're kind of rapidly transforming the banking processes to make them much more efficient and also cost effective. Through the examination of vast data sets, AI algorithms are able to automate manual tasks, free upping, the employees to focus on more higher value work. Now, for example, AI chatbots now handle many routine customer service queries about account balances, payments, and many such tasks. Now, this greatly improves the response times and also frees up the call center staff that way. So while I spoke about this example which focuses or which talks about the use of AI and how it's probably helping one such vertical of the financial sector, the banking sector. So can you share some case studies or success metrics around how deep MMs impact on a client's business efficiency so that our listeners can understand more about your service and specialization?
Yeah, there's as I said earlier, there's kind of two ways to look at it. There's kind of the efficiency, like how much time does it save the traders, and then also how much does having an improvement in accuracy in the model actually help drive more revenue or drive more P&L. So in terms of efficiency, one of our killer apps seems to be for a tool for the sell side. So for the dealers, this is an over-the-counter market. So everybody who wants to buy or sell a bond has to go to a dealer and ask them for a price, and hopefully negotiate a sale purchase of the bond. And one of the things that one of the tasks that the traders on the sell side, the dealers have to do in order to hopefully gain business from their clients, like the hedge funds and the insurance companies, et cetera, that want to buy or sell bonds, is they have to send out runs. Runs are basically just indicative prices. They're not firm prices, but they just indicate where the trader is willing to negotiate for a particular bond. And now, if a trader is covering hundreds of bonds, that task might take them 2 or 3 hours every single day, if not more. And with our tool, it takes about 15 minutes because our tool actually helps the user come up with their runs in a way that's customized for them. And so this is really helpful. And then on the other side, when it comes to P&L improvements from the accuracy of the model, we estimate that if you look at the improvement in investment grade accuracy versus something like CP plus, based on the latest numbers that we see, that translates, according to some math that I have in the white paper, to about a 6.5% improvement in the P&L. Based on some assumptions about the variance of the P&L that the existing company or that the existing desk already has. So if you look at a 6.5% improvement in the risk-adjusted P&L, that's a lot of money especially for the big shops. So on a per trader basis, if you look at it, a trader, senior trader at a large desk probably has a budget in terms of P&L of $30 million, and maybe they get to take home 1 to 3 million of that themselves. In order to do that, a 6.5% improvement, 30 million, translates to about $2 million. So if you think about it, we only charge an amount much lower than $2 million a year for the trader to use our product. And if it can improve their job by 6.5% or $2 million, it's really, really worth it. So, and it's because, and the reason for that is when you improve the accuracy, you decrease the variance in their P&L. And if you decrease the variance of their P&L, you improve the Sharpe ratio. And if you improve the Sharpe ratio, you're effectively improving your risk-adjusted P&L. So that's very important. So, and the same sort of concept would apply to like algo trading. If you can improve the risk-adjusted P&L, that's the main metric that everybody looks at. And then even on the buy side, if you can improve the variance of the mark-to-market that you have to make at the end of every day when you report the value or the VAR of your mutual fund, et cetera, if you can improve the variability of that, you improve your Sharpe ratio without any other changes to your process. And so that's a huge deal.
Well, yes, I completely agree. That's definitely a huge deal by having a 6.5% of improvement in risk-adjusted P&L. That's a lot of money for the traders, and also the amount of time that a trader saves. Like you mentioned, from like it takes around a journal of 2-3 days, and whereas your tool can help it cut down 15 minutes. So that's huge time saving as well as cost saving on the other hand. So that's pretty impressive. And Nathan, and thank you for sharing those stats with us. Now, moving ahead, I think AI trading also automates research and data-driven decision making, which allows investors to spend less time researching and more time overseeing actual trades and advising their clients. Just like in the earlier response, you shared about certain metrics of how they can save, how a particular trader can save time. So one survey also found that traders who use algorithmic trading increased productivity by 10%. And because AI trading uses historical financial data to inform decisions, there is less risk for human error and also more room for accuracy. But when we're talking about, trading, overall trading, or the corporate bonds or the entire credit trading industry, I think some sort of risk is definitely involved when you're investing something. So how trading execution risk can be lowered using accurate signals from artificial intelligence?
Yeah, I mean, just by having a more accurate signal, that effectively decreases the risk, because the way that risk is usually measured is the variance of your P&L. And a big factor in the variance of your P&L is the way that you're measuring the price itself. Because you can imagine that the variance in your P&L, part of it is composed of, whether how, like the variance in the quality of your decision making, but part of your decision making is based on the pricing. And so if that is less accurate, then that's going to cause some variability in your decision making. And then also in terms of the reporting of, or just recording whether that was a good decision or a bad decision, if you have a less accurate signal, then it's harder to even tell if it was a good or bad decision when you look back historically. So that also helps decrease the risk component. But yeah, I mean, and just conceptually, the traders call it getting picked off, especially the sell side traders, when they put out an indicative run and then somebody quote unquote picks them off, that means that they put out a bad run, and then they kind of feel obligated to fulfill it, even though it's they don't legally have to. But it's a situation where it becomes a risk if you're not making the best decision in terms of pricing. So that also helps. And then also in terms of risk, the other thing that really helps in having an accurate model, especially historically, as you mentioned, is that with, for example, corporate bonds, historically, they only trade, every so often. Some are trade obviously more liquid than others. But regardless, they're not trading constantly. So if you want to build a correlation matrix so that you can evaluate the risk profile of your portfolio, it's really important to be able to have prices that are at the exact same point in time when you're looking at the historical snapshots of that and trying to build that matrix. When all you have are trade data that are not aligned in terms of time, then it's kind of difficult to do that. You have to sort of, interpolation is not going to be very accurate typically. So with our model, it can come up with a pretty accurate price in between trades that are comparable across all the different bonds. And so then it really helps you build up your covariance matrix that you can use then to optimize your portfolio in terms of both P&L and risk.
Right, and I think when you have accurate prices, it kind of helps deal you with all the other challenges that comes up in terms of a risk rating or analyzing the risk profile of your portfolio. Now, many experts have also predicted that deep learning will continue to revolutionize the financial industry in the coming years. So we'll likely see the use of more AI and deep learning in many complex ways to analyze data, identifying patterns and insights, or automating processes that way. So in investments and trading, I think AI may become more advanced enough to make more accurate market predictions and also execute some sophisticated trading strategies. So one last question for you, Nathan. What do you think is the future of AI or deep learning in the trading, portfolio management, or any particular trends that you can predict in the coming years?
Yeah, one that we're looking at is, well, so we view our model as a type of large event model. So it's kind of playing off the what we call the large language models, except for instead of talking about natural language tokens, we're talking about events. In our case, we're predicting the price of corporate bond events, which are transactions, and it can be applied. Obviously, the same type of model could be applied to many different financial use cases and even non-financial use cases like healthcare or logistics and probably many others. And what I think would be the holy grail of a model that we could create eventually is one where it's very flexible. Just like large language models are zero-shot learners, which means that they can accomplish tasks that they've never been trained on via being prompted. What I think the holy grail for large event models would be to be able to make predictions about an event stream that had never been trained on. So, for example, let's say that we had trained a model on all of the fixed income data, and then we applied it to equity options, but it had never been trained on equity options exactly. But still, because of the way the model is trained in a very flexible way, it's able to make good predictions for those equity options. I think that's the future, is having more large general purpose models, kind of like what we're seeing with the large language models, but it's just a different class of tools. And this type of model, I think, would be extremely useful across so many use cases.
Right. I think I agree with you on this point that probably we'll be seeing more such use cases across different industries. So I think a significant driving force behind the continued development and adoption of these AI models will be the potential to create a more inclusive credit evaluation system, one that takes into account individuals lacking a probably traditional credit history. And I think nonetheless challenges will arise in terms of how we are adopting these models, and specifically issues concerning transparency, bias, and data privacy and security will become more paramount as we will see a gradual widespread adoption of these models. But eventually, I think what we really need to focus is on responsible and ethical use of AI or deep learning technologies, and I think that's possible with both industry as well as the regulatory bodies. And with the continued efforts and ongoing efforts, I think we will be able to achieve that. Well, thank you so much, Nathan. It was a pleasure having you with us on our podcast. I think we explored a different angle in terms of how AI or deep learning, for that matter, can help and get more access to the corporate bonds, and what all different impact it can have on the overall trading and portfolio management.
Thank you very much for having me again.
Great. Thank you so much, Nathan. So this is for our listeners. Stay tuned for our upcoming podcast, and you can view and listen all our previous podcasts on Spotify and other leading platforms. Thank you so much.